Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka may face a high United States tariff under a proposal by the United States Trade Representative or USTR related to the importation of goods produced with forced labor. According to a recent USTR statement, countries that have implemented and enforced import prohibitions on forced labor goods or have committed to such measures through reciprocal trade agreements may qualify for an additional duty rate of 10%. However, economies that do not meet these requirements could be subject to a higher additional duty of 12.5%. Sri Lanka has been identified among the countries that may fall into this high tariff category. The proposal has been introduced under Section 301 of Trade Act of 1974, a key U.S. trade law used to address trade practices considered unfair by the United States. In the same announcement, the USTR also proposed a special textile mechanism. This would allow a specified volume of apparel and textile imports from certain economies to enter the United States at a reduced Section 301 tariff rate. The countries eligible for this arrangement have not yet been identified. USTR Ambassador Jamieson Greer indicated that the continued importation of goods made with forced labor by some trade partners creates an uneven competitive environment for American workers. He further noted that while some economies have taken initial steps to restrict the importation of forced labor goods, others have yet to implement sufficient measures. Reports indicate that Sri Lanka could be among 45 countries subject to the proposed 12.5% rate. Meanwhile, Reuters reported that 14 economies have met the criteria for the lower 10% rate. These include Canada, Ecuador, the European Union, Indonesia, Mexico, Pakistan, Argentina, Bangladesh, Cambodia, El Salvador, Guatemala, Malaysia, Taiwan, and the United Kingdom. The USTR has indicated that the proposed tariff framework could apply to a total of 60 countries. In a related development, the US State Department Trafficking in Persons report has classified Sri Lanka as a Tier 2 country for the past 2 years following an upgrade from the Tier 2 watch list category. Tier 2 status indicates that a country is making efforts to meet minimum anti-trafficking standards, while a Tier 2 watch list status reflects limited or stagnant progress in these efforts. Sri Lanka's total government external debt stood at $37.47 billion at the end of the first quarter of 2026, according to official data released by the Public Debt Management Office. The latest March 2026 statistical debt bulletin showed that external debt declined by $195 million compared with the previous quarter. Meanwhile, the central government debt component within total gross public debt reached $98.97 billion during the period under review. According to the report, multilateral debt continues to form the largest share of Sri Lanka's external debt portfolio, accounting for 38% of the total. Commercial debt represents 34%, while bilateral credit accounts for the remaining 28%. The bulletin further indicated that around 81% of commercial debt consists of international sovereign bond issuances. The balance is made up of foreign currency term financing facilities. Within the multilateral segment, the Asian Development Bank and the World Bank remain the largest lenders, accounting for more than 82% of total multilateral debt. In the bilateral debt category, non-Paris Club countries hold 59% of the total, with China representing a significant share. Paris Club countries account for the remaining 41%. The report also noted that Sri Lanka has made significant progress in addressing its debt crisis following the public debt service moratorium declared in April 2022. Following the bilateral debt restructuring agreements and the completion of an international sovereign bond exchange in late 2024, the government has continued to regularize debt servicing to its external creditors. The latest figures suggest a continued effort to strengthen debt sustainability while maintaining commitments to international lenders. Sri Lanka's current account recorded a deficit of $532.4 million in April, reversing the surplus recorded during the same period last year, according to the latest external sector performance report released by the Central Bank of Sri Lanka. The report indicated that deterioration was mainly driven by a widening trade deficit, lower tourism earnings, and a higher primary income deficit. As a result, the cumulative current account balance for the January to April period moved to a marginal deficit of $0.9 million compared to a surplus of $1.12 billion recorded during the corresponding period of 2025. The merchandise trade deficit widened significantly in April as imports rose by 45.7% to $2.46 billion, while exports increased by 10.9% to $1.07 billion. A major contributor to the high import bill was fuel expenditure, which surged to $886 million amid rising global oil prices and increased import volumes. Vehicle imports also continue to place pressure on the external sector, with spending on personal and commercial vehicles reaching $208 million during the month. Meanwhile, the services sector surplus declined by 37.8% in April, largely due to weaker tourism performance. Tourist arrivals fell for a second consecutive month to 135,643 visitors, while tourism earnings declined by 38.8% to $157.1 million. For the first 4 months of the year, tourism earnings stood at $1.11 billion, reflecting a year-on-year decline of 19.4%. According to the report, the Middle East conflict has affected travel demand and regional connectivity, contributing to the decline in tourism arrivals and earnings. However, workers' remittances continue to provide support to the external sector. Remittance inflows increased by 18.8% year-on-year to $767.9 million in April, while cumulative inflows for the first 4 months of the year exceeded $3 billion. In the financial sector, foreign investments in government securities recorded a marginal net inflow, while the Colombo Stock Exchange registered a net foreign outflow during the month. Despite external sector pressures, gross official reserves remained at approximately $6.8 million at the end of April, providing import cover of around 3.5 months. The report also noted that Sri Lankan rupee depreciated by 5.4% against the US dollar on a year-to-date basis, reflecting heightened external pressures. The government's fuel subsidy allocation of 57 billion rupees is scheduled to conclude by the end of June, according to the Ceylon Petroleum Corporation chairman. The chairman stated that the recent fuel price revision was introduced as the allocated subsidy fund nears exhaustion, while efforts continue to minimize the impact on the broader economy. According to the chairman, the government has been absorbing a significant portion of fuel cost in recent months. He noted that the subsidy current amounts to 100 rupees per litre of diesel and 20 rupees per litre of petrol. He further explained that despite the latest price increase, local fuel prices remain below the actual cost level due to temporary support measures. The chairman said that the subsidy program was funded through a government allocation of 57 billion rupees, which is expected to be fully utilized by the end of June. Meanwhile, the International Monetary Fund, in its latest staff report on Sri Lanka, stated that the cost recovery pricing for fuel remains an important component of the country's economic reform program. According to the report, fuel prices have not yet fully reflected increased costs since April, following higher global oil prices linked to tensions in the Middle East. The report also noted that authorities plan to compensate the Ceylon Petroleum Corporation for past losses through an on-budget transfer, while fuel subsidies are expected to remain limited and be fully phased out by the end of September 2026. On the electricity sector, the report indicated that cost recovery pricing has not yet been fully achieved, with further tariff adjustments expected to reflect rising fuel and generation costs. The chairman revealed that fuel import expenditure exceeds $520 million in May due to higher global oil prices and increased import volumes. Prior to the Middle East conflict, monthly fuel import costs ranged between $100 and $120 million. He warned that continued increases in global energy prices could have further pressure on foreign exchange reserves and the wider economy. According to the chairman, the Ceylon Petroleum Corporation is currently incurring losses of 129 rupees per litre of diesel and 60 rupees per litre of petrol. He also urged the public that efficient energy use would help ease pressure on the economy during a period of elevated global energy costs. Sri Lanka's tourism industry has achieved a significant milestone, with tourist arrivals surpassing the 1 million mark during the first 5 months of the year. According to the latest tourism figures, the country welcomed a total of 1.01 million visitors between 1st January and 28 May. This reflects a marginal decline of 1% compared to the corresponding period last year. However, industry performance showed notable improvement during May. During the first 28 days of May, Sri Lanka recorded 134,530 tourist arrivals, representing a 12% increase compared to the same period a year earlier. Average daily arrivals also improved to 4,805 visitors, up from 4,290 recorded during the corresponding period last year. India continued to remain Sri Lanka's largest tourism source market during the period, contributing 56,063 visitors and accounting for 42% of total arrivals in May. The United Kingdom ranked second with 8,582 visitors, while China followed closely with 8,439 arrivals. On a year-to-date basis, India remained the leading source market with 245,981 visitors. The United Kingdom ranked second with 97,427 arrivals, while Russia recorded 75,963 tourists. The latest figures have strengthened optimism within the tourism industry as Sri Lanka works towards its target of attracting 3 million visitors by the end of 2026. To achieve that goal, the country will need to attract nearly 2 million additional tourists during the remaining 7 months of the year. Industry stakeholders remain hopeful that sustained promotional efforts, improved connectivity, and growing international interest in Sri Lanka as a travel destination will help support the ambitious target. Let's take a look at this week's Treasury-bill auction results. With the recent Treasury-bill auction, the 91-day T-bill rate stands at 9.84%, up by 48 basis points. The 182-day T-bill rate stands at 10.01%, up by 33 basis points. And the 1-year T-bill rate stands at 10.02%, up by 19 basis points compared to the previous week. Thank you for watching. We'll be back next week.